Right now, central banks collectively hold more gold than U.S. Treasuries for the first time in decades. A quiet but consequential shift that most headlines are barely addressing, and one that raises important questions about how global monetary confidence is evolving, especially if you take a moment to think through what this signals beneath the surface. This content is for informational and educational purposes only and should not be considered financial advice. For most of the post-war period, U.S. Treasuries have functioned as the backbone of the global reserve system. After Bretton Woods, even once gold convertibility was formally severed in the early 1970s, Treasuries inherited gold's role by proxy. They offered liquidity at scale, deep and continuous price discovery, and, crucially, the assumption that the fiscal and political structure behind them was stable enough to be treated as effectively risk-free. For central banks, Treasuries became less a trade and more an operating asset, collateral for settlement, a store of reserves, and a mechanism for managing exchange rates. Over time, gold moved in the opposite direction. It never disappeared from balance sheets, but it was gradually reframed as a legacy asset, illiquid, non-yielding, operationally inconvenient, and politically unfashionable in an era that prioritized financialization and paper claims. The expansion of the eurodollar system and sovereign bond markets reinforced this shift. Trust was placed increasingly in institutional frameworks rather than in physical settlement. That is why the current reversal matters. Central banks do not change reserve composition quickly, and they do not do it for narrative reasons. These institutions respond to structural incentives, delivery certainty, and long-term credibility. When gold begins to reclaim balance sheet relevance relative to treasuries, it suggests a reassessment of what constitutes a dependable reserve under modern conditions. This is not about imminent collapse or price forecasts. It is about how trust is measured when systems grow more complex, more leveraged, and more politically constrained. If this historical pivot stands out to you, it is worth thinking through what changed and what did not. Share your perspective in the comments, or continue with the next analysis in this series. The 2008 financial crisis marked a quiet but lasting inflection point in how central banks think about reserves. Before that shock, the dominant assumption was that liquidity equaled safety. If an asset traded in sufficient size, cleared through established intermediaries, and sat within the core of the global financial system, it was treated as reliable by default. The crisis exposed the limits of that logic. Markets remained liquid until they suddenly were not, and counterparties considered unquestionable were revealed to be structurally fragile. From that moment forward, reserve management began to shift from optimization toward resilience. Central banks started asking different questions. Not how efficiently reserves could be deployed, but how they would behave under stress when correlations converge and legal or political constraints appear. Counterparty risk, once abstract, became tangible. The idea that a reserve asset could be frozen, rehypothecated, or impaired by actions outside a central bank's control moved from theory into institutional memory. This is where gold quietly regained relevance, not as a trade and not as a statement, but as an asset with no embedded counterparty and no dependence on settlement chains that can fracture under pressure. In a paper-based system, most assets are promises layered on top of other promises. Gold, by contrast, settles in physical form, or it does not settle at all. That binary quality matters to institutions tasked with planning for low probability, high impact outcomes. Importantly, central banks do not forget crises the way markets do. Policy frameworks evolve slowly, but once risk is identified, it tends to remain embedded for decades. The post-2008 period has been characterized by a gradual re-weighting toward assets that improve balance sheet durability rather than yield or short-term flexibility. This does not imply distrust in any single market. It reflects a broader recognition that system-wide stress reveals where theoretical liquidity diverges from real-world delivery. If you see reserve behavior through that lens, the pattern becomes less surprising. If you find this framework useful, consider continuing with the next segment or sharing how you interpret these structural shifts. For decades, U.S. Treasuries benefited from a simple assumption that sovereign debt issued by the world's reserve currency issuer could scale indefinitely without meaningfully changing its risk profile. That assumption was not irrational in its time. Debt levels were manageable relative to growth, interest rates trended lower over multiple cycles, and global demand for dollar-denominated assets absorbed expanding issuance with little friction. Under those conditions, Treasuries offered yield, liquidity, and institutional convenience in one package. That framework has become less stable. Sovereign debt levels have risen materially, not just in the United States, but across advanced economies, while growth has become more constrained by demographics and productivity. At the same time, interest rate volatility has returned as a structural feature rather than a temporary anomaly. For reserve managers, this changes the calculus. Duration risk, once a secondary consideration, now directly affects balance sheet stability. When rates move sharply, the mark-to-market impact on large Treasury holdings becomes non-trivial, even if default risk remains remote. Fiscal sustainability also enters the discussion more explicitly. This is not about imminent insolvency, but about incentives. High debt loads reduce policy flexibility, and central banks are aware that fiscal pressures can influence monetary outcomes over long horizons. When issuance expands faster than underlying economic capacity, reserves begin to carry embedded policy risk. That risk is difficult to model precisely, but it is not invisible to institutions tasked with preserving purchasing power rather than maximizing return. Treasuries still dominate in terms of market depth and transactional utility. However, the risk-reward profile has shifted from what it was in a zero-rate world. Higher yields compensate for some risks, but they also introduce new ones, particularly for holders operating at scale. Unlike private investors, central banks cannot easily trade around volatility without signaling or destabilizing markets. They are effectively price takers with long holding periods. In that context, diversification becomes a balance sheet decision rather than a market view. Assets that do not carry duration risk, refinancing risk, or policy-driven dilution begin to serve a different function. Gold does not replace treasuries in liquidity terms, but it offsets specific vulnerabilities that emerge as debt and rates rise together. This adjustment is incremental and largely non-public, which is precisely why it matters. Reserve portfolios reflect how institutions assess long-term system stability when headlines fade. If this perspective resonates, consider sharing your interpretation in the comments or continuing with the next part of the analysis. Gold occupies a distinct position on central bank balance sheets, precisely because it sits outside the modern web of financial claims. Unlike sovereign bonds or reserve currencies, gold is not issued by any government, does not represent a promise to pay, and does not depend on the solvency or policy discipline of a third party. That absence of issuer risk is not theoretical. In a system where most assets are layered claims, clearing through custodians, correspondent banks, and legal jurisdictions, gold's value is anchored in direct ownership and physical settlement. This neutrality becomes more relevant as financial systems grow more politicized. Sanctions regimes, capital controls, and regulatory coordination have expanded the circumstances under which assets can be restricted, frozen, or reclassified. From a central bank's perspective, these are not moral or ideological considerations. They are operational ones. Reserve assets are held to function under adverse conditions, including those where political alignment cannot be assumed. Gold's appeal lies in the fact that it does not require permission to exist on a balance sheet once it is in custody. There's also a structural distinction between paper gold markets and physical gold reserves that institutional holders understand clearly. While price discovery in gold often occurs through futures and unallocated markets, central bank gold is typically held in allocated form with clear title and minimal delivery risk. This separation matters. In periods of stress, premiums between physical metal and paper claims can widen, revealing where liquidity is abundant and where settlement certainty resides. Central banks position themselves deliberately on the side of certainty. Gold also avoids entanglement with another country's monetary policy. Holding treasuries implicitly links a reserve portfolio to the fiscal and monetary decisions of the issuing state. That linkage can be beneficial in stable periods, but it is not neutral. Gold, by contrast, does not transmit policy choices across borders. Its value fluctuates, but it does not impose external policy dependencies on the holder. None of this suggests that gold is a superior asset in all conditions. It lacks yield, can be operationally cumbersome, and does not provide the transactional liquidity that sovereign bonds do. Its function is narrower and more defensive. But within a diversified reserve framework, that narrowness is a feature, not a flaw. When central banks increase gold holdings, it is best understood as a preference for optionality and balance sheet independence, rather than a statement about markets. If this framing aligns with your view, consider continuing with the next segment or sharing your interpretation of gold's evolving role in the reserve system. Over the past decade, the global financial system has become more fragmented, not in a dramatic or sudden way, but through a steady accumulation of political and legal constraints. Sanctions, trade disputes, and strategic realignments have altered how cross-border finance operates, even when markets appear calm on the surface. For central banks, this environment changes the assumptions that once underpinned dollar-centric reserve strategies. The dollar system remains dominant, but it is no longer viewed as uniformly neutral. Access to dollar clearing, custody, and settlement now carries an implicit geopolitical dimension. Assets that were once treated as universally accessible can, under certain conditions, become subject to restrictions outside the control of the holder. For reserve managers, this introduces a new category of risk, jurisdictional risk, that cannot be diversified away within the same currency framework. Emerging market central banks are particularly sensitive to this shift. Their reserves serve not only as buffers against market volatility, but also as tools of monetary sovereignty. When trade relationships diversify and supply chains realign, holding reserves concentrated in a single currency tied to a specific political bloc becomes less efficient. Diversification in this context is less about optimizing returns and more about preserving operational flexibility across multiple scenarios. This does not mean an abandonment of the dollar. Instead, it reflects a gradual decoupling at the margins, incremental increases in non-dollar assets, bilateral settlement arrangements, and the accumulation of gold all point toward a desire to reduce dependency rather than to replace the existing system. These adjustments tend to occur quietly, through balance sheet composition rather than public declarations. Sanctions policy has also altered perceptions of asset safety. While such measures are designed to be targeted, their existence demonstrates that reserve assets can be mobilized as instruments of statecraft. Central banks, by design, plan for contingencies that may never occur. The probability may be low, but the impact is high enough to warrant structural hedging. From this perspective, reserve diversification is a rational response to a more multipolar and rules-contingent financial order. It reflects a reassessment of how trust is distributed when economic integration coexists with political fragmentation. These trends unfold slowly, but their cumulative effect reshapes institutional behavior. If you view reserve management as a window into how states perceive long-term system reliability, this pattern is worth watching closely. Share your interpretation in the comments, or continue with the next segment as we examine how these shifts appear in the data itself. The global reserve system was built on the assumption that economic integration would continue to deepen and that financial infrastructure would remain broadly neutral. That assumption has weakened. Over time, geopolitical fragmentation has introduced friction into areas once treated as purely technical: clearing systems, custody arrangements, correspondent banking, and access to settlement networks. These are not abstract concerns for central banks. They define whether reserves function as intended during periods of stress. Sanctions regimes have been a key inflection point. Regardless of their justification, they demonstrate that reserve assets can be constrained by political decisions external to the holder. This shifts how risk is assessed. An asset may be liquid, widely traded, and well-priced, yet still carry conditional accessibility. From a reserve management perspective, that conditionality matters as much as credit quality or duration. Trade realignments reinforce this dynamic. As supply chains diversify and regional blocs deepen, trade invoicing and settlement begin to follow those patterns. Emerging market economies, in particular, are navigating a more complex environment where economic exposure is spread across multiple partners with differing political alignments. Concentrating reserves in a single currency tied to one jurisdiction becomes less efficient under those conditions. Diversification improves optionality, not performance. This is where reserve behavior diverges from market narratives. Central banks are not attempting to forecast geopolitical outcomes. They are responding to incentive structures. When the probability of disruption is low, but the consequences are severe, institutions hedge structurally rather than tactically. Incremental adjustments, slightly lower dollar weightings, higher allocations to alternative assets, increased gold holdings, reflect that logic. Importantly, this process is gradual. The dollar remains central to global finance, and no viable substitute exists at comparable scale. What is changing is the margin. The system is becoming more multipolar, and reserve portfolios are adapting accordingly. These changes are visible not through rhetoric, but through balance sheet composition and custody choices. Emerging market central banks tend to move first because they face higher exposure to external shocks. Their reserves are defensive by design. When they diversify, it signals a reassessment of how trust is distributed across the system rather than a rejection of any single asset. Viewed this way, reserve diversification is less about ideology and more about resilience. It reflects a world where economic interdependence coexists with political fragmentation and where access cannot be taken for granted indefinitely. If you interpret reserve shifts as institutional signals rather than market bets, this trend becomes easier to contextualize. Consider sharing how you see these dynamics evolving. Or continue with the next segment as we look at what the data itself reveals. Recent data on reserve composition offers a rare window into how central banks approach long-term portfolio management. Unlike market investors, these institutions do not adjust allocations in response to daily price moves or headline volatility. Instead, reserve shifts are deliberate, structural, and often incremental, reflecting changes in perceived credibility, counterparty risk, and operational certainty. When we see allocations to gold rising relative to U.S. Treasuries, it is not a short-term signal, but the cumulative result of years of reassessment and risk evaluation. Central banks operate on horizons measured in decades rather than quarters. They weigh factors such as delivery risk, settlement certainty, and policy optionality, all of which are invisible to conventional market metrics. The pace of change in reserve composition underscores this conservatism. Even modest reweighting is meaningful because it reflects internal modeling of systemic risk and balance sheet durability. Small, consistent adjustments are far more indicative of institutional intent than abrupt headline-driven trades. The data also highlight differences across regions. Emerging market central banks tend to exhibit faster relative shifts toward neutral assets like gold, reflecting higher exposure to geopolitical and counterparty risk. Advanced economies, by contrast, move more slowly, balancing the liquidity and operational convenience of dollar assets against structural concerns. This divergence in behavior reveals how incentives and risk environments shape institutional decisions, rather than any singular narrative about the dollar or gold markets. When examining the numbers, one can also observe a subtle decoupling between paper market positions and physical holdings. Central banks often maintain allocated gold with full ownership, reducing delivery risk, while U.S. Treasuries remain largely in traditional clearing systems. This distinction matters because it signals an emphasis on settlement certainty under stress, rather than market speculation. Physical custody acts as a hedge against scenarios where contractual claims on paper assets might be impaired or delayed. Taken together, the data reveal a consistent theme. Reserve management is a long-game exercise, shaped by structural incentives rather than headline-driven volatility. Gold is not being accumulated to chase returns, and treasuries are not being abandoned due to immediate concerns. Instead, the portfolio shifts communicate a preference for durability, optionality, and operational independence over short-term performance. It is a reflection of institutional memory, system trust, and planning for contingencies that may only manifest decades later. For observers, these data signals provide context for interpreting macro trends without overstating urgency. They show how central banks translate structural risk into asset allocation decisions over time. If this perspective resonates, consider reflecting on what these allocations imply for system credibility, or continue with the next segment as we explore the critical turning points that frame this evolving reserve landscape. What makes the current shift in central bank reserves particularly significant is not the volume of gold or the reduction in U.S. Treasury holdings, but the underlying signal it sends about institutional confidence. This is not a story of imminent collapse, and it should not be interpreted as a sudden loss of faith in the dollar system. The dollar remains deeply entrenched with unparalleled liquidity, settlement infrastructure, and market depth. What is changing is the balance between confidence and control, how central banks perceive the reliability of a single sovereign issuer, when structural and political risks accumulate over time. For decades, treasuries were treated almost as extensions of operational certainty. They were assumed to deliver liquidity, clear through trusted systems, and maintain value regardless of geopolitical friction. That assumption is still largely valid, but it is no longer unexamined. Rising debt levels, periodic policy stress, and global regulatory fragmentation have created a situation where an overconcentration in any single issuer carries latent vulnerabilities. Central banks, whose primary objective is the preservation of reserves under a wide range of contingencies, are increasingly recognizing that operational resilience may require modest diversification away from sole reliance on dollar-denominated paper. This is a subtle recalibration, not a dramatic rejection. Gold, other reserve assets, and incremental shifts in treasury allocations reflect a hedging of credibility risk rather than a speculative bet. It is an insurance strategy embedded in the long-term memory of institutions that have experienced multiple crises, observed delivery disruptions, and managed exposure to political conditionality. In practical terms, it is the difference between trusting a counterparty implicitly and verifying their reliability under extreme scenarios. Even small adjustments in allocation communicate that thought process clearly. The turning point lies in recognizing that trust in the system is conditional, not absolute. Central banks continue to rely on the dollar for liquidity and settlement, but they are also constructing buffers against rare but consequential operational interruptions. These decisions are methodical, incremental, and grounded in structural incentives rather than headline-driven fear. They reflect the institutional understanding that durability and optionality are as important as market access, particularly when managing portfolios at scales that exceed most private investors' comprehension. Viewed through this lens, the current reserve shift is less about signaling doom than about managing the inherent tension between confidence and control. Institutions are signaling that they value sovereignty, settlement certainty, and long-term credibility as much as yield or liquidity. It is a nuanced adjustment that is largely invisible to daily market commentary, but highly meaningful for understanding systemic incentives. For observers, the lesson is that reserve behavior offers insight into how trust is allocated across the system. It is a signal of subtle structural caution, not panic. Consider reflecting on how this calibration of confidence versus control might influence broader financial architecture, or continue with the next segment as we examine the resulting implications and long-term trends emerging from these deliberate portfolio choices. The broader implication of these shifts in reserve composition is less about market timing and more about systemic resilience. Central banks are signaling a recalibration of trust within the global monetary architecture, emphasizing durability, optionality, and operational certainty over yield or headline performance. Gold AS resurgence on balance sheets should be interpreted in this context. It is an instrument of risk management, a hedge against structural vulnerabilities, and a store of value independent of any single sovereign issuer. It is not a speculative bet, nor does it suggest imminent disruption to the dollar system. Reserve systems evolve gradually, often in ways invisible to conventional market observers. Small reallocations, incremental increases in neutral assets, and adjustments to duration and currency exposure accumulate over years. These decisions reflect institutional memory, long-term planning horizons, and an awareness of the operational realities that arise during periods of stress. They are deliberate and structurally motivated, shaped by incentives, geopolitical considerations, and the historical behavior of financial markets under pressure. This perspective also reframes how we interpret price signals in both paper and physical markets. A widening premium between physical gold and unallocated claims, for example, is less a speculative anomaly than an expression of delivery risk and institutional preference for certainty. Similarly, shifts away from heavily concentrated Treasury holdings do not imply a loss of confidence in the dollar per se. They reflect a strategic balancing of counterparty exposure and portfolio resilience. Ultimately, these patterns highlight a central truth about reserve management. It is an exercise in long-term credibility. Institutions aim to preserve purchasing power, maintain liquidity, and protect operational autonomy, all while navigating an increasingly complex geopolitical landscape. Changes are subtle, measured, and cumulative, reflecting incentives and structural realities rather than short-term market sentiment. For observers and analysts, the takeaway is that these shifts provide insight into how central banks allocate trust and manage systemic risk. They are signals of prudence, not panic. Engaging with this framework allows for a more nuanced understanding of global monetary evolution. Consider sharing your perspective in the comments or continuing with related analysis to explore how these structural trends may shape the financial system over the coming decades. When we step back and examine the cumulative trends in reserve management, a clear narrative emerges about how central banks approach long-term stability. These institutions are not reactive traders. They are strategic stewards of liquidity and credibility. Their allocation shifts, whether incremental increases in gold or nuanced adjustments in Treasury holdings, reveal an underlying emphasis on operational certainty, delivery risk mitigation, and preservation of optionality across scenarios that could unfold over decades. Observing these changes allows us to glimpse how trust is distributed within the system and how institutions prioritize resilience over headline performance or short-term gains. Gold's resurgence is particularly telling. Unlike other assets, it does not carry issuer risk, nor is it subject to political constraints or settlement fragility. Its growing weight on balance sheets signals a deliberate choice to maintain a hedge against structural vulnerabilities inherent in relying heavily on a single sovereign currency. When we consider how small adjustments accumulate over years, it becomes evident that reserve systems evolve incrementally, guided by incentives and historical behavior, rather than abruptly in response to headlines. This process reflects a measured calibration of confidence and control, revealing how institutions reconcile systemic risk with operational functionality. At the same time, examining regional differences and the pace of diversification highlights the interplay between geopolitical exposure and institutional priorities. Emerging market central banks, often more exposed to sanctions, trade realignments, and policy conditionality, have been quicker to adjust holdings while advanced economies balance structural risk against liquidity needs. These behaviors underscore that reserve management is fundamentally about probability-weighted planning, preparing for low-likelihood, high-impact events without implying an immediate market crisis or dramatic collapse of existing frameworks. Interpreting these signals requires separating narrative from structure. Price movements, spreads between physical and paper markets, and relative shifts in allocations all communicate how institutions weigh delivery certainty and long-term optionality. Each incremental adjustment tells a story about institutional memory, operational incentives, and the evolution of systemic trust. Observing these patterns over time allows analysts and informed observers to develop a more nuanced understanding of global monetary architecture, beyond the simplifications of daily headlines. As we consider these dynamics, the question becomes not whether gold or treasuries will outperform, but what the composition of reserves reveals about the stability, resilience, and incentives that underpin the financial system. For those seeking to understand these trends in depth, reflecting on reserve behavior provides insight into the invisible architecture of trust that shapes global finance. Share your interpretation of these shifts in the comments, subscribe for deeper macro analysis, or explore related discussions on the evolution of monetary systems. By engaging thoughtfully, we can better appreciate the structural signals embedded in central bank behavior and the long-term considerations guiding global financial stability.